Oil prices move up and down on Middle East headlines. Rising energy costs continue to weigh on global economies, compounded by US tariffs, rising memory chip prices, and AI competing for local resources as well, such as electricity and water, for example. So all that is building up in inflation expectations, but this morning sentiment is still better because oil prices are down, but uncertainties persist. So the Fed and the Bank of Canada are expected to maintain their rates unchanged today, but investors will be focusing on how policymakers around the world assess the latest developments in the Middle East, rising oil prices, and to what extent they will look past the energy-led price pressures. So welcome to Swissquote's Daily Market Talk. It's Wednesday, 18th of March. I'm İpek Özkardeskaya, and we will talk about central banks, oil prices, but also technology and AI. But before we do, please keep in mind that opinions are my own, and this is not financial advice.
This show is brought to you by Swissquote.
So crude oil pushed higher yesterday as Middle East tensions escalated after reports of the killing of a senior Iranian figure called Ali Larijani. Experts today suggest that the latter could eventually push Iran to intensify its attacks on Gulf countries and further disrupt oil flows. But this morning, oil is sharply down again, and that's on news that Iraq signed a deal to resume oil exports via Turkey and avoid the Strait of Hormuz. Earlier this month, Saudi Arabia also announced that it's rerouting its oil exports toward the Red Sea, so the region is reorganizing and preparing for the idea of a prolonged war in the Middle East. So this reorganization will take time. Oil export levels will not be fully restored overnight, and we will soon start seeing shortages on physical markets, and the latter will likely keep oil prices under a positive pressure. But as oil starts flowing through alternative routes, the knee-jerk pressure seen on oil prices at the first weeks of the Iranian war could wane as well. And the latter will matter for global economies, obviously, that have been pressured by higher energy prices and rising hawkish central bank bets as a result of it. Yesterday, remember, the Reserve Bank of Australia raises interest rates for the second straight meeting to deal with rising inflationary pressures, and partly due to the Middle East war. Today, the Federal Reserve and the Bank of Canada are expected to stay pat, and the Fed will revise its growth and inflation expectations as well, and the dot plot will also be on the menu. So the latest data pointed that the price pressures in the US have already been building before the latest spike in oil prices, suggesting that the coming months will be challenging in terms of price pressures and the Fed policy. So the Fed members are brought this week to decide whether to look past the price pressures, look through them, assuming that they will remain short-lived, or act. In this case, action would be not to cut the interest rates this year as it was anticipated earlier this year. So all eyes are on the Fed decision, the economic projections from the Fed and the dot plot, along with the Bank of Canada verdict and the latest inflation readings from the euro area. They are expected to have rebounded in February. But inflation numbers will continue to see its asymmetric reaction from the market, as we know that the rising oil pressures will push inflation higher. So yes, the softer the starting point, the better. But we also know that inflation is rising today due to higher oil prices, and the latter will have an impact on central bank policies. To what extent? That's the million-dollar question. So the US dollar is weaker this morning against most majors, pulled lower by also a sharp fall in oil prices. The euro dollar consolidates gains above the 115 mark, and the dollar yen pushes away from the problematic 160 mark. On the index front, the Nikkei is up by more than 1% at the time I'm talking here this morning. Kospi rallies almost 5%. US and European futures are pointing at an encouraging start to today's session. There is no suspense. Oil prices are and will remain the common denominator for global risk appetite. The lower and the more sustainable, the better. But I would also argue that the lack of near-term resolution in the Middle East will keep oil prices volatile and well supported. And the longer this uncertainty lasts, the bigger the impact on physical availability will be, and the harder it will get to bring these prices to pre-war levels. Voila, that's the oil part of the story. Unfortunately, rising energy prices is not the only inflationary risk to global economies. It's the major one though, as it impacts the price of everything from agricultural to industrial goods, transportation, services, everything you can think of. But there are also the US tariffs and the AI, for example, competing with local economies, local communities for resources like electricity and sometimes water, threatening to push their prices higher as well. And inside technology, the memory chip shortage, which has been aggravated by the high and very rapidly growing AI demand, had also pushed the industry into a deep shortage, pushing prices higher by sometimes triple digits. A shortage that the Korean memory chip maker SK Hynix expects to persist over the next 4 years, they say. So the latter will likely push the price of electronics higher and squeeze the margins for the companies that produce these goods. And here we are talking about PCs, smartphone makers, but also car makers, appliance makers, TV manufacturers, and you name it. In this context of deepening shortage, memory chip makers remain very popular among technology investors, and earnings from Micron Technology, American memory chip maker, are due today after the US closing bell, and expectations are sky high. Analysts are looking for a revenue of around 19 billion US dollars in the first quarter of this year, more than doubling year on year, and earnings per share in the $8.5 to $9 range, a more than 5-fold increase compared to the same period last year. Obviously, the surge is driven by booming demand for memory chips used in AI infrastructure, with tight supply continuing to push prices and margins higher. So the question is not whether results will be strong, we know they will, but whether they can beat the already elevated market expectations and back a further rally in the stock price that yesterday hit a fresh all-time high level above the $462 per share level. And if you're looking for more technology news, well, China is where the action is happening today with their OpenClaw, an open source agent framework that doesn't just answer questions like OpenAI does, but can actually execute tasks from managing files to running commands. So this shift from AI assistants to AI agents, which was also pointed at as the next big step in AI race by NVIDIA CEO Jensen Huang earlier this week, remember, has sparked a race among Chinese technology giants. Alibaba is integrating, for example, agent tools into its enterprise platforms, while Tencent is embedding them across WeChat and its cloud ecosystem. And boy, Tencent has such a reach in China. So the potential here is huge. AI agents drive demand for cloud services, strengthen platform stickiness, and create new enterprise revenue streams. As a result, investors are reacting fast. Minimax, for example, which is a smaller Chinese AI player with its own open cloud-based agent, surged more than 20% in Hong Kong trading today as excitement over AI agents is spreading in China, though the government is not necessarily very much happy about it. But the battle for agent dominance in China is just beginning, and giants like Alibaba, Tencent, or smaller players like Minimax are all positioning themselves to capture the next phase of AI adoption. Hang Seng Index in Hong Kong helps investors capture that exposure to a broadly diversified Chinese technology portfolio. In the US, companies like Google and Meta Platforms are also investing heavily in agentic AI that could eventually help convince investors that their heavy AI spending is justified, but also very much needed. Meta today is trading with more than a 20% discount compared to last August's all-time high levels. His PE ratio is down to near 21, while Google is down by more than 15% with a PE ratio still above 33. Now, deeper price pullback in these technology giants could soon vacuum in the shoppers looking for good deals, but they must also look past the massive investment plans from these big technology companies that are increasingly relying on debt. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow after the Fed decision and just before the Bank of England, the Swiss National Bank, and the European Central Bank decisions. But until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.